20 investments that are recession-proof. Inflation is causing upheaval in the markets, making everything from gas and groceries to hotels more expensive. But just because the near-term economic picture is negative doesn't mean you should stop saving and investing. However, you may want to give your portfolio a once-over to see if you are positioned in the most recession-proof manner possible. No investment is completely immune to an economic downturn, and markets can always be unpredictable. But some investments are traditionally more resilient during difficult economic times. Here's a look at some investment options to consider to recession-proof your money. Commodities. Commodities are raw materials, such as metals and grains, that can be used singly or as components of other products. Long considered a potential hedge against inflation, commodities give investors a few ways to invest. The easiest, and perhaps one of the less risky, is through a mutual fund that invests in businesses that are involved in commodities, mining, energy or agricultural companies. Precious metals. Precious metals like gold and silver are often in demand during stock market sell-offs and times of overall economic unease. The reason is that precious metals are seen as a store of value, something tangible that investors can physically hold onto while their intangible assets, like stocks, go down in value. Gold also tends to rise during low interest rate environments. Since gold doesn't pay a dividend, it becomes more attractive when other instruments are not paying much income either. Money market accounts. Money market accounts are another example of a federally insured deposit account where you can trust that your money is safe. Money market accounts are typically semi-liquid hybrids of checking and savings accounts, with limited checkbook access and modest annual percentage yields. Some online banks, in particular, have begun offering high-yielding money market accounts, and this can be a good place to hide out while you wait for the current economic and market uncertainty to pass by. Travel and leisure companies. Travel and leisure companies, such as hotels, airlines, cruise ships and online booking sites, rely on a strong economy to generate profits. When times get hard, consumers predictably reduce their discretionary expenses, and this can hit the travel industry hard, especially when it follows a pandemic that had a devastating effect on the travel industry. However, consumer demand for travel is high, and as the economy claws its way out of recession, lost bookings are likely to come back. Waste disposal companies. Waste disposal companies are typically considered defensive because no matter the state of the economy at large, humans both generate trash and don't want it around. Weekly trash pickups typically continue across the nation no matter what the economic backdrop, and this makes waste disposal a good bet during a recession. High dividend stocks. High dividend stocks are riskier than FDIC-insured products like savings accounts and CDs. However, their potential for return is higher. During the market sell-offs that usually accompany recessions, high dividend stocks may hold up better than others because investors are getting a cash return in addition to the potential stock price return. High dividend stocks also tend to be more mature companies with significant cash flow in defensive industries, which adds another layer of protection against wild market swings. You can still lose money on high dividend stocks in a bear market, but you'll be protected somewhat by the incoming cash payments and the high survivability of companies like this during recessions. Market indices. No less than famed investor Warren Buffett, the Oracle of Omaha, himself, suggests that buying index funds is the best option for most investors. Coming out of a recession and bear market for stocks, market indices will by definition be on the upswing. No one can time the market or know when a recession or bear market will end. But by definition when the bear market flips to a bull market, indices like the S&P 500 will rise. Educational courses. Sometimes the best investment in a recession is an investment in yourself. Rather than having to worry about where stocks, bonds or gold are trading, you can use this time to learn a new skill or join a new career-oriented organization. By broadening your skill set, you may be more attractive to companies in need of top-tier talent to help pull themselves out of the recession.